G'day everyone, welcome back to Pete's Investing and Trading channel. Today we've got a special one for you. We're looking at the CCI 14 strategy with the average down, which we always cover. We're going to compare that against the same strategy but in reverse. We're going to be shorting the shares to see what the effects are. In this video we'll cover the entry and exit of the trading, the average down rules for each strategy. We're going to review each chart for the companies we're covering and look at the table of results for each strategy. And stay tuned until the end of the video to review the trading guidelines and trading rules. Don't forget to review and playlists and cover the trading strategies we cover, share price and indices reviews, and this video will be covering the share trading strategies playlist. In the strategy place where we cover the simple trading strategy, the average down process, and some money management ideas. Again, some legal stuff. We're not offering financial advice, but rather this is an educational series to help you make better decisions. So let's get started. So I'm going to demonstrate the entry and exit strategy with two scenarios. The first scenario is our common one, which we've been using for some time, where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5% gain. Take your profits and wait for another trade using the entry rule. We average down when the close of the day declines by at least 5% and the CCI 14 breaks above the zero line. We then buy the double the quantity of shares from the previous trade we made. Note, we don't use stop losses. Again, watch until the end of the video to review the trading rules and guidelines. And the second strategy demonstrates the same strategy for the long position but in reverse to short the shares. Entry is made when the CCI 14 crosses down from the zero line. We exit when the close reaches a 5% decline from the entry point. We average down our holdings when the CCI 14 breaks down below the zero line and the average price has declined by at least 5%, and we short the double number of shares. So now we're going to be talking about some of the charts we're referring to. And I want to first of all go to this chart. Again, this is Volkswagen. And what I want you to look up and focus on here, let me bring up this note. Now focus on the chart pattern as we go through each of these companies. Note each one has a unique pattern or fingerprint, so there are no guarantees of the same results in future. We backtest beginning in January 2007. This allows us to measure the results factoring the GFC in 2008, 2009, the COVID period, and more recently the Ukraine war. We trade with a 2% $2,000 trade per trade. So in other words, when we buy a number of shares, we buy $2,000 worth. Now, if you want to invest more, you can invest more, or if you want to trade less, you can trade less, but we're using as a standard $2,000. Note the profitability on these lines. So in particular, the drawdown of each. So you can see here, this is a drawdown. So from that highest low to the lowest point, that's called a drawdown. It's measured from the highest point of the profitability to the lowest point. This is important because we measure the profit over drawdown as a percentage to compare one strategy against the other. Note the profitability of the charts. We have a baseline of $100,000. So that's our $100,000 baseline. That's our $100,000 baseline there. So we see where the that one there. We see where it's dropped below the 100,000 if we're losing. If our share price is declining, in other words, we're not actually losing money because we're buying outright with our own money. This allows us to see the effect of profitability if it falls below the $100,000. And you'll see there coming up in one of the charts. I'll show you what happens if it pulls up all that $100,000. Ultimately, the strategy will always close out its trade profitably, so long as you can pick the right chart with a profitability. We show the indicators for each, and it's here down here we're showing the CCI 14, so we can visualize when we enter and exit the trades. Lastly, I've chosen and tracked the results of a set number of blue chip companies. Keeping this list consistent does two things. I can't be accused of cherry picking stocks that only do well. And two, each stock has a unique pattern. That is, some consistently grow, others chart sideways, and others gradually decline over the years. But ultimately, we see the profitability of results of the strategies. So let's first of all go into looking at the charts that we're looking at for each of these. So first I want to show you here that this is Volkswagen. As you can see, I want you to focus on the chart pattern and how it's performing. So as you can see here, it's been quite a dizzy ride. It's been going a bit of a spike here in 2021 and slightly been declining since then. Profitability, you can see here for the long strategy, it's been more rewarding than the short strategy, only because the share price has ultimately been going better than been going well in the right direction for us. Let me first now go to and explain the shorting process along with the long process. Let's look at the Commonwealth Bank of Australia. So what I want you to focus on here is, let's break it down. Let's look at this little trade here. So you can see here, this is the long position. We enter the trade long there. When the CCI 14 breaks above zero, we go long, and we bought there $2,000 worth of shares. We bought 25 shares. So we hold that position. The price has been going sideways. We finally break out when it's broken above the 5% gain. Here it just missed out the 5% gain, and we closed out 5% gain here. So we closed out that trade. So we made a nice little gain there. This just demonstrates the shorting process. So you can see here, the CCI 14 breaks below there. The CCI 14 breaks below the zero, and we short the position. So you can see there, we held for that position for some time. The price went against us. We ended up shorting another lot of shares there because it declined by more than 5%, or the decline was greater than 5% against us. So we ended up shorting the shares. And finally, we ended up closing the shares because we gained a 5% gain from our average price. And average price would have been somewhere there, not from that point there. So that little trade, that short trade there demonstrates both a short example, but also a averaging down example. The average down example for a long trade is pretty much the same thing in reverse. So if you go there long, in that position there, the price went against us, we dropped by more than 5%. We go another lot of shares long there, distinguished by that little jump in that step there. We close out at that point there when the average price was greater, or the close was greater than the average price. You can see there the profitability closed out there of 14,170, where we started off at 13,806. And this little trade on the short position closed out the profitability of 2,473. We started a profitability at 2,279. Just demonstrating the short and long positions of our strategies. So that was Commonwealth Bank of Australia. Again, looking at the big picture. Overall, it's been going in a northerly direction, doing quite nicely. So the long position has generated greater returns than the short position in this case. Johnson & Johnson. So what I want to focus on is the share price movement and the profitability of the long and the short profitability. You can see there greater profitability going long, 5964 versus short 4616. And we had a bit of a averaging down process there, and we ended up seeing a bit of a growth there in the shorting position. I'll go through these fairly quickly. JP Morgan. Again, greater profitability, just 6553 versus 4171. Again, the share price has been going north. We spoke about Volkswagen. Let's look at BHP Australia. There's a bit of a roller coaster pattern, as you can see, going up and down, and a bit of a mixed result. But ultimately, the long position was greater in result. 16,725, and that's breaking even. It's about break even to 100,000. A bit of a downturn there after this little fight there. And lastly, I want to show you Caterpillar. This is an interesting case. So the long position generated $22,000. Again, nice little performance for Caterpillar, going long in most of the case. But where it started averaging down short positions, you can see there it utilized all our $100,000. So just be very careful when you're doing this, that you don't average down too often if you're doing this manually. And in this case, I'm doubling up on the shares, so probably it would have generated less of a downturn had I not doubled up on the shares. But I just want to demonstrate the effects of putting too much money against you when you're averaging down. But most of the time, if you can pick the right charts, if they're going sideways in that sort of pattern, or at the very least if you're going long. The other thing you've got to be careful of as well, if you're going short or going long, you receive dividends if you're in a trade for some time. If you go short, you're going to pay out those dividends to people going long. So just be mindful of that. That brings me back to the results. Now this is the results for the long positions. You can see here the stocks we traded. the generation of the profits generated for each, number of contracts, the maximum number of contracts traded since 2007, and the maximum drawdown at each one respectively. So it generated monthly revenue about 485. Again, that's our long position entry and exit and average down rules. Compare that with the shorting strategy. So you can see here the profits made for the shorts for each of those respective stocks, the drawdown, and it generated $71 a month on average over the 184-month period since January 2007 till today, in 7th of May 22. And to summarize the two, I've done this little chart here, basically demonstrating the long strategy versus the short strategy. So overall, we generated a lot bigger return or revenue for the long strategy versus the short. A lot smaller, almost half the amount of drawdown compared to the short, and a much greater profit over drawdown result. So again, just covering some of the entry and exit rules. So today we covered a couple of simple trading strategies with a better probability of price moving in our direction. There are many videos which show you how to enter a trade, but most of them don't clearly explain when to exit the trade profitably. In this video, we showed you an effective way of exiting the trade profitably. Note also we don't use stop losses. That's a sure way of losing money. So with good money management, the average down process works fairly well. The average down process, again, instead of stop losses, is being used. With disciplined money management, we show you how to effectively average down and ultimately close out the trade profitably. The approach has been back tested on stocks, CFD indices, commodities, and Forex currencies. Again, the key here is good money management, especially in trading leveraged instruments such as CFDs, ETFs, etc. And today we bought our shares outright with our own funds. We show the calculated funds required when following the drawdown approach. We go to backtest since 2007 for taking effect the GFC in 2008, 2009, and more recently the COVID-Ukraine conflict downturns. On average, we show the returns that would have been generated had you traded $2,000 per trade, and these returns do not show the returns of dividends, so any dividends would have been added as extra. Some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. Buy stocks which pay dividends. Do a quick search and make sure the company you're about to buy has paid a dividend recently in the past or is about to pay a dividend if you're considering buying. Don't short positions, go long only, as demonstrated in this video. If you short a position which pays a dividend, you'll end up paying that dividend to someone else who went long. And don't trade on the news. Price has already been factored in the share price. If you read an article in the finance pages, make sure you don't trade it based on that article alone. Thanks for watching. Don't forget to click the subscribe button, the like button, and the notification bell. Happy investing, and see you in the next video.